Hello, I'm John Kreitler. Welcome to This Week in the Markets. On Wednesday, the Federal Reserve raised the federal funds rate to a range of 5.25 to 5.5%. In his prepared remarks, Chair Powell talked about rates being higher for longer, that the job was not done, and all meetings were live. In questions and answers, he was a bit more nuanced, talked about the road to a 2% inflation rate. That nuance was important. Rate hike cycle has been going on now for over 12 months. It's restrictive, and the Federal Reserve acknowledges that. However, it's not restrictive enough as core CPI is still at 4.5%. It needs to accelerate its strategy in order for inflation expectations not to get unanchored by the consumer. If this was to go on to 2024, 2025, with the rate hike cycle and the core CPI being too high, people will expect inflation. That's not what the Federal Reserve wants. It wants to get the job done quickly, but not too quickly, in order to tip the economy into recession. An interesting crossroads for the Federal Reserve. For its part, the bond market stays inverted. The 210 spread again is at about 100 basis points. Stock market indexes stayed along their year-long highs, with a rotation out of technology into industrials and healthcare. Corporate earnings have been quite company specific. Certain companies have done well, beating estimates, raising their forecasts, raising dividends and share buybacks, and the markets have responded favorably to those companies. The next 2 weeks will bring the jobs report and the all-important core CPI report the second week of August. Thank you again for watching This Week in Markets. I'm John Kreitler, and have a great week.